Starting a business is a bit like a game of chess. Your opening moves can determine the outcome. There's numerous options. Obviously, you've got companies, you've got trusts, you've got partnerships, you've got sole traders, and you can actually have combinations of those. So you may have a partnership of trust depending on the circumstances of the enterprise. Many people that come to us that have an existing business and have a trust, they have no idea how their trust structure works. Many of them don't even understand the difference between the trust and the trustee company. So what we normally do is we give them a simple example, such as this pen. So I say to them, look, I'll give you this pen, and now we have created a trust. I've given that pen in trust to you, and that particular person is the trustee, and they can use that pen however they like in amongst their family members. So they might think, well, my son's got a pretty ordinary pen, so I'll let him use the pen for the year. Or they might decide that this pen's a pretty good pen, I can rent this pen out and make some money. And so at the end of the year we've made a profit. We then have to work out what are we going to do with the profit, and so we can distribute that profit perhaps down to the son who has no other income. So we've created a trust. The trust is the pen earns income, and the discretionary ability of the trustee, who is looking after the pen, decides what we're going to do with that income at the end of the year. So we have some tax planning opportunities. So that's basically what a trust is. There is something in trust, in this case it's the pen. The trust then generates income or uses that asset and other assets that it acquires to create a profit, which then it can distribute to its family members. If the business is such where we can be put in a position where our main client goes broke and we're owing a supplier a substantial amount, then the business is at risk of being sued to recover those. And if we're running as a sole trader or maybe as a partnership, then our personal assets would be at risk. So with a company, provided we haven't breached any legal requirements, then the company's responsible for those risks, and they could only be sourced out of the assets of the company, not our personal assets. Let's suppose that Bob comes along and you've decided that Bob would be a good fit for the business. Bob buys into the business, maybe he's bought 20% of the shareholding of the business, then obviously Bob would get a 20% share of the profits. There's an option then if maybe Fred comes along, the business has grown and we need somebody else and another person who's going to put money into the business. So maybe you or Bob or both of us will sell some of your shares to Fred. So this is the advantage of a company, particularly where you may need to admit new partners into the business. You can't do that in a discretionary trust. As a sole trader, we're responsible for everything. Our personal assets are at risk. Any profits that we make are taxed to us. Partnerships generally, there are two types of partnerships. Usually there's a partnership, mum and dad type partnership, where dad's perhaps just a electrician or something and he's splitting his income with his wife. That's not so bad. But where you get two independent people to come together and create a partnership, then you have some real issues. Because like Bob and Harry come together, they create a partnership, perhaps they're electricians. What can happen then is each partner is jointly and severally liable for the actions of the other partner. So if Harry goes off and enters into some sort of contract without Bob's knowledge, and that goes sour, and Harry and the business is exposed to some significant litigation, and Harry hasn't got any money, then Bob's responsible for all the debts. And there's no such thing as a perfect structure. The idea is to get the one that best suits your circumstances. Now, what we look at is the KISS principle. Let's keep it simple and cost effective. If we determine that, look, we agree there's no real risk and there's no perhaps real tax planning opportunities at the moment, then we'd probably consider keeping it simple, maybe as a sole trader or a partnership, keeping an eye on the business, seeing how it goes until it perhaps gets to the stage, think, now hang on, now it's getting so big or successful, we need to put it into a structure or a trust, maybe from a tax planning, asset protection point of view, but also perhaps from a business credibility point of view, because a lot of people prefer to deal with companies rather than individuals. A business structure should also be looking at exit strategies. So with a company, it's easy to perhaps sell shares if need be and then maintain the company, or we can sell the business. If it's an individual, partnership, a trust or whatever, then there's the tax implications there as far as capital gains tax, as far as access to some of the business tax concessions. So getting a structure right at the start, you need to consider the end game as well. If you found this information valuable, please like this video and subscribe to our channel. My name's Paul and thank you for watching.